Hey guys, can you believe this? Right now, 1 out of every 5 recent graduates in the U.S. is out of a job. I recently came across a Stanford University report that made my blood run cold. It says employment among Americans aged 22 to 25 has dropped by 13%. You heard that right, 13%. And just yesterday, the latest data from the U.S. Labor Department showed job openings in July fell to 7.18 million, hitting a new 10-month low. Sure, we all saw a slowdown coming. Certainty is everywhere, and AI is taking over tons of entry-level jobs. But this number came in 200,000 below expectations. That's downright scary. Some of you might be thinking, what does employment have to do with me? Even if you're not worried about your job, the September rate cut definitely affects everyone. That's right, while young people are sweating over employment, the Fed is sweating too. And their decisions are pointing straight to the September meeting and even to our wallets. Hey everyone, I'm Luna, here to break down macro trends into real numbers. What's really going on with the U.S. job market? Can a Fed rate cut really fix a 20% employment drop? Why does the Fed care so much about jobs data? And what should we do? Should we ride the wave in U.S. stocks and bonds or run for safe haven assets? Don't worry, in this video, I'll break down the real story behind U.S. employment, the Fed's rate cut strategy, and the opportunities we can grab, especially those two common traps people are already falling into. Listen closely, and you might just figure out where the next big move is headed. First, let's tackle the big question. Is the U.S. job market really weak, or does it just look weak? A lot of people see employment rate plunging and assume the whole U.S. economy is crashing. But that's not exactly true. Let's look at two reports. First up, the JOLTS report from the U.S. Labor Department. July, job openings fell below 7.2 million for only the second time since late 2020. In other words, aside from a brief dip last year, the last time openings were this low was during the pandemic, when the U.S. economy and labor market went through massive turmoil, and that 7.18 million figure was way below economists' expectations of 7.38 million. It looks like the trade wars started by Trump created enough uncertainty to make companies extra cautious about hiring. But that doesn't mean every industry is crashing. Layoffs only increased slightly, and the number of Americans voluntarily leaving their jobs held steady at 3.2 million, the same as June. What does that tell us? A large number of U.S. workers are still confident they can find better paying jobs with more opportunities. So where are the jobs disappearing? The report shows the biggest drops were in healthcare, social assistance, retail, and leisure hospitality, especially healthcare, which has been cutting jobs since the start of the year. Openings in that sector are at their lowest since 2021. Now let's look at that Stanford study. Jobs for 22 to 25-year-olds in entry-level roles, like basic coding, translation, and customer service are getting crushed. Why? Because AI can do all those jobs now. Copilot writes code 3x faster than a newbie, with no bugs. AI translation is fast, cheap, and time zone proof. Customer service AI is online every minute and never argues with customers. Companies do the math. Why hire and train a new employee when you can buy an AI tool and have a seasoned worker supervise it? It's much cheaper. But weak youth employment doesn't mean the whole economy is failing. Check out this contrast. Employment fell 20% for 22 to 25-year-olds, but barely moved for 26 to 30-year-olds, and actually rose for those over 30. Why? Because experienced workers use AI to amplify their skills. For example, a programmer with 5 years of experience can double their efficiency by using AI to write complex functions. A doctor who uses AI for initial CT scan screenings and then double-checks the results can reduce misdiagnosis rates and see more patients. Companies would rather pay experienced employees more than hire new graduates whose roles could be replaced by. So, what's happening in the U.S. job market isn't a total collapse, it's a localized crisis and a structural breakdown. But this is exactly why the Fed is considering rate cuts. A localized crisis can spread, and a structural breakdown will eventually drag down the entire labor market. What will happen to unemployed healthcare workers, and how will that impact the market? Could mass unemployment lead to weaker consumer spending, which in turn causes even more job losses? And without entry-level jobs as stepping stones, how will young people gain experience and grow into experts? In 5 or 10 years, could entire industries face a talent shortage? Once the labor market fractures, it's incredibly difficult to repair. This is what the Fed is afraid of. Look at how several top Fed officials have been publicly hinting at rate cuts. Concerns about the labor market are their main reason for considering easing monetary policy. Fed Governor Waller explicitly said the Fed should cut rates at the next meeting, and even hinted at multiple cuts over the next 3 to 6 months. He believes in acting before the labor market gets worse, because once it starts deteriorating, it can spiral fast. Atlanta Fed President Bostic also reaffirmed his view that rate cuts are coming. He wrote in an article, "Right now, I think policy is slightly restrictive." He added, while price stability remains the top priority, the slowdown in the labor market is significant enough to justify some policy easing. A 25 basis point cut later this year may be appropriate. Meanwhile, Minneapolis Fed President Neil Kashkari noted that since the neutral federal funds rate is around 3%, this suggests there is still some room for moderate rate cuts in the coming years. Powell himself previously said that policy must adapt to the economy, which basically gives the green light for rate cuts. These comments have reassured investors, and the JOLTS report has only fueled speculation that the Fed may cut rates this month. For the market right now, the Fed's rate cut card is already on the table. It's not a guess. It's a given. Think about it. The economy is slowing, the dollar is weak, companies are cautious, demand is soft, and young people can't find jobs. If the Fed doesn't cut rates to stimulate the economy, are they just waiting for things to freeze over? But will rate cuts really save employment? Don't jump to conclusions. History tells us the Fed doesn't cut rates to save jobs, it cuts to save assets. What really gets young people back to work isn't interest rates, new industry growth. Can rate cuts bring new growth? Absolutely. We can already see that as rate cut signals get stronger, capital is moving, and the market is perking up. Most noticeably, demand for treasuries is rising. Let's look at U.S. bonds. The yield curve is flattening. The spread between 2-year and x-10-year yields has narrowed to 59.5 basis points. The 30-year yield, which the market has been watching closely, approached 5% early Wednesday before seeing significant buying. Clearly, investors are jumping in with real money. At the same time, rising rate cut expectations have also slowed selling in U.S. Treasuries, helping long-term bonds in other regions stabilize overnight. The yield on the UK 30-year government bond briefly touched 5.75% on Wednesday, a level not seen since 1998. But as the bond market stabilized a bit later that day, it ended up closing 7 basis points lower. Eurozone bond yields also fell, though the French 30-year remains near 2009 highs, and the German equivalent is approaching a 14-year peak. But let's keep it real. Rate cuts aren't all sunshine and rainbows. The Fed is walking a tightrope. Kashkari threw cold water on the excitement. Tariffs are still rising, and inflation could bounce back. And he's right, we're already seeing it. Even though many companies are afraid to raise prices and lose customers, tariff-related cost increases are adding pressure. Some firms have already passed those costs on to consumers. Others are hesitating but getting nervous. If rate cuts stimulate spending and people start buying more, companies might finally hike prices, and inflation could flare up again. So that's why this rate cut is more about prioritizing employment. With inflation control as a secondary goal for the Fed. It's not an aggressive all-out cut. They're playing it by the data. What does this mean? It means retail investors can't just assume rate cuts equal market rallies. You've got to keep an eye on upcoming non-farm payroll and CPI data. Don't just blindly follow market hype. Think carefully. After the rate cut, which opportunities are real and which are traps? Luna has sorted out 3 investable opportunities for different risk appetites, plus 2 traps you must avoid. Each comes with clear logic and examples. Just follow along. The first opportunity is for low-risk friends. It's simple. Follow the bond market and get a piece of the pie. The surest opportunity right now is in the bond market. As mentioned earlier, the 10-year Treasury yield fell by 4.27 basis points, and the 30-year bonds were snapped up like crazy as they approached 5%. That's institutions positioning early. How can ordinary folks invest? No need to buy treasuries directly, it's hassle. Just go for a US 10-year Treasury ETF like TLT, which tracks long-term treasuries. After the rate cut takes effect, you can profit from both price appreciation and interest income. Also, consider high-grade corporate bonds, like those from Microsoft or Apple. These giants have strong credit, low default risk, offer slightly higher returns than government bonds, and are less risky than stocks. But here's a key point. The ADP employment data comes out on Thursday, followed by non-farm payrolls on Friday. If these numbers disappoint again, bonds could rally further. But if the data suddenly improves, suggesting the job market isn't as bad as feared, expectations for rate cuts might cool, and bonds could pull back. So don't chase the rally, wait for a dip to buy. Remember, making money in bonds takes patience. Don't expect to be the rich overnight. Second, if you can handle moderate risk, let's talk about a dual strategy, defensive plus cyclical. In past rate-cutting cycles, two types of assets performed best: consumer staples, things people need no matter what, and interest rate-sensitive real estate. What if you combine them? You get a portfolio that's both resilient and profitable. Consumer staple giants are classic defensive plays. Think Procter and Gamble. No matter how bad youth unemployment gets, people still need to buy toothpaste, laundry detergent, and groceries. These companies have stable cash flows and paid dividends. P&G currently offers a 2.5% dividend yield. Even if the market swings, their stocks tend to fall less. More importantly, rate cuts mean people have a bit more cash. They might not splurge on luxury items, but they won't cut back on daily essentials, which directly benefits these companies. Real estate also has huge potential this time. Even Buffett is betting on it. Rate cuts mean lower mortgage rates. The average 30-year mortgage rate has already fallen from 7.3% to 6.8%. If the Fed cuts in September, it could drop below 6.5%, spurring more home buying. That means REITs, real estate investment trusts, will benefit. Apartment and retail space rentals will rise, and property valuations will increase. For example, Singapore's REIT ETF attracted over SGD 300 million in the past year, with a total return of 10.7% because the market is betting on lower rates. Another overlooked gem is utility stocks. Utilities have stable cash flows, people need electricity and gas no matter what, and they carry high debt loads. Rate cuts directly reduce their financing costs, boosting profits. Third, if you can tolerate volatility, consider dipping into cyclical sectors now. After rate cuts stimulate economic recovery, these sectors could see explosive growth. But remember, high reward comes with high risk. These assets can also plummet, so keep positions under 30%. Industrial stocks are classic. Fed rate cuts are like loosening the reins for them. Their performance is closely tied to the economic cycle. After rate cuts, lower borrowing costs encourage businesses to invest in equipment and expand production, meaning more orders for these companies. Historical data shows that in the past 3 rate cut cycles, industrial stocks gained an average of 15% in the 6 months following the cuts, outperforming the broader market by 5%. Right now, these stocks haven't moved much yet, so it might be a good time to get in. Small cap stocks are another dark horse. They might not look like much now, but once economic sentiment improves, small caps tend to bounce back harder than large caps. The S&P 600 Small Cap Index averaged a 22% gain over 12 months during past rate cut cycles, far surpassing the S&P 500's 15%. But be careful, small caps are volatile. Last year, they fell 10% in a single month at one point, so always set a stop loss. There's also a higher risk, higher reward play, emerging markets. Simple logic. Fed rate cuts weaken the dollar, so money flows out of the US into emerging markets seeking higher returns. For example, contrarian King James Rogers is targeting Chinese tourism now. Let's talk about those two traps. Have you fallen into them? Trap number 1, junk bonds and low-rated corporate debt. It's tempting. Some junk bonds offer 8% yields, but these companies are already financially shaky. A weak job market could hurt their revenue and send default risks soaring last year. The U.S. junk bond default rate rose from 1.5% to 3.2%. If a real recession hits, that number could break 5%. Avoid bonds issued by small-cap renewable energy firms. Many are struggling to even pay interest. Trap number 2, rate cut hype stocks that have already soared. Some sectors like precious metals and certain tech stocks have already surged over 30% purely on rate cut expectations. Jumping in now could leave you back. Remember, when good news is fully priced in, it becomes bad news. Once the cut actually happens, these stocks might pull back. Look for assets that haven't rallied yet but will truly benefit from lower rates, not ones that are already overheated. The market always has opportunities. What's rare is the vision. To see them clearly, the Fed cutting rates isn't free money. And AI isn't a monster. It's all about how you respond. One last warning. When the party is wildest, the bill is about to arrive. As we seize opportunities from rate cuts, don't forget risk control, set stop losses, manage position sizes, and on a personal level, boost emergency savings, pay down high-interest debt, and upgrade your skills. Only by balancing returns and risk can you stand firm through economic cycles without becoming another casualty of market volatility. When the next bell rings, I hope you're at the table, not on the menu. The wheels of time keep turning. What moves have you made? Ready to catch this wave? Let's chat in the comments. I'm Luna, here to help turn macro trends into numbers in your account. Follow me so you don't miss the next big move.